In March, Margaret celebrated her 73rd birthday. Throughout her entire career, she had been a disciplined saver. Her retirement account balance had reached $280,000. She felt secure in her financial position. She believed entering retirement would eliminate money-related stress. However, when November arrived, an IRS letter appeared in her mailbox. The penalty amount was $6,250. This was charged because she hadn't withdrawn funds from her personal retirement savings. At her kitchen table, Margaret trembled as she held the letter. She couldn't comprehend how keeping her own funds in her own account could result in punishment. What she hadn't realized was that IRS oversight continues well into retirement. Actually, they monitor 5 particular areas with increased intensity after you stop working. A single error in these areas could drain thousands from your savings. My name is Edward, and I work as a senior policy analyst focused on retirement finance and tax regulations. For many years, I've dedicated myself to helping retired individuals navigate these complex regulations to safeguard their hard-earned savings. In this video, I'll expose the 5 areas where IRS monitoring intensifies once retirement begins. What I'm sharing isn't based on hearsay. I'm not using fear to manipulate you. Everything comes directly from official government sources like irs.gov, ssa.gov, and medicare.gov. I'll provide you with precise instructions for self-protection. However, watching through to the conclusion is essential. There's a commonly overlooked error that surprises almost everyone without exception. This mistake affects your Social Security income, your Medicare costs, and your annual tax obligation. Most people in retirement only learn about this problem after the damage is done. Allow me to share Robert's experience with you. When this happened, Robert had reached 73 years of age. His engineering career had spanned 4 full decades. Upon retiring, he had a dependable pension, government retirement benefits, and his traditional IRA contained $320,000. Robert practiced financial prudence consistently. He kept up with current events regularly. He made efforts to remain well-informed about important matters. However, one particular regulation escaped his attention completely. Once Robert reached age 73 in January 2023, the IRS began tracking a critical deadline. By April 1, 2024, he needed to complete his initial required minimum distribution withdrawal. Unfortunately, Robert remained unaware of this requirement. The financial professional he'd been working with had left the industry. His retirement account administrator mailed him documentation, which Robert mistakenly assumed was merely informational. He reasoned that since the money belonged to him, he could withdraw it whenever necessary. The April 1st deadline passed without action. Robert withdrew absolutely nothing from his account. Later in December 2024, his tax preparer identified the oversight. The mandatory withdrawal amount had been $12,500. Robert's actual withdrawal total was $0. What was the financial consequence? A charge equal to 25% of $12,500. The calculation came to $3,125. Those funds were simply lost. This happened because of an error Robert never knew he was committing. The situation actually became even more problematic. Since Robert postponed his initial withdrawal until April 2024, the requirement for 2 separate distributions fell within 2024. Both his initial required withdrawal and his second one were now due. This meant $25,000 in additional taxable earnings compressed into one single year. The result was movement into a higher taxation bracket. Additionally, it activated a program Robert had never encountered previously. The program was called RMDs. Fast forward 2 years to 2026, and Robert's Medicare Part B monthly costs unexpectedly increased by $69.90. This occurred because the IRS had forwarded his 2024 earnings information to the Social Security Administration. Between penalties and increased monthly insurance costs, Robert's total loss exceeded $4,000. The entire problem stemmed from not knowing how IRS monitoring changes after retirement begins. Now let me break down these 5 critical areas for you. Area number 1, mandatory minimum withdrawals. This comes straight from official IRS publication 590B. Once you reach age 73, withdrawals from your traditional retirement accounts become mandatory. These accounts include IRAs, 401k plans, and 403b arrangements. The official term is required minimum distribution, abbreviated as RMD. Leaving funds indefinitely in these accounts is no longer permitted. The government requires collection of deferred tax revenue. Your initial RMD withdrawal deadline is April 1st, following the year you turn 73. Each subsequent annual RMD must be completed by December 31st. The withdrawal amount calculation divides your account value by an IRS longevity factor. While your account administrator can perform this calculation, withdrawal responsibility rests entirely with you. Now here's where people run into trouble. Numerous retirees incorrectly assume indefinite tax deferral remains available to them. Their assumption is that retirement savings function as permanent tax shelters. This assumption is completely incorrect. Missing an RMD deadline results in a 25% IRS penalty on the withdrawal amount you failed to take. For example, if your required amount was $10,000 but you withdrew nothing, the penalty becomes $2,500. This penalty can be reduced to 10% through correction within a 2-year window, though IRS Form 5329 must accompany your tax filing. Penalty forgiveness is possible when failure resulted from reasonable circumstances, provided you take immediate corrective action. Area number 2, taxation of Social Security benefits. Here's what creates confusion for most people in retirement. Social Security income doesn't automatically receive tax-free status. The IRS employs a calculation called combined income for determining what portion of Social Security faces taxation. This combined income calculation includes your adjusted gross income, tax-exempt interest earnings, and 50% of Social Security income. For individuals filing separately, combined income falling between $25,000 and $34,000 makes half of Social Security subject to taxes. When combined income exceeds $34,000, up to 85% faces taxation. Married couples filing together face thresholds of $32,000 and $44,000 respectively. The problem develops this way. People withdraw funds from retirement accounts regularly. They collect monthly pension distributions. They earn returns on their investments. Every single source contributes to the combined income calculation. Before they realize what's happening, 85% of their Social Security becomes taxable. Come April, they're confronted with an unexpected tax obligation. There's an even more serious consequence waiting. When combined income reaches certain levels, it activates IRMA penalties. IRMA represents income-related monthly adjustment amount in full. This functions as an additional charge applied to Medicare Part B and Part D monthly costs. Your income details get transmitted from the IRS to Social Security automatically. Social Security examines your tax filing from 2 years in the past. For individuals whose 2022 earnings exceeded $103,000 or couples exceeding $206,000, their 2024 Medicare costs increase by no less than $69.90 monthly. At the upper income tiers, monthly surcharges can surpass $419. Most people don't become aware until noticing the deduction appearing in their Social Security payment. Fortunately, you have protective options available. Federal tax withholding from Social Security payments can be established through Form W-4V submission. Available withholding percentages are 7%, 10%, 12%, or 22%. This strategy eliminates surprise tax bills when April arrives. Alternatively, quarterly estimated tax submissions using Form 1040-ES remain available. Required submission dates are April 15th, June 15th, September 15th, and January 15th annually. Insufficient tax payments throughout the year result in IRS underpayment penalties being assessed. Area number 3, the income limits test. This regulation particularly affects individuals who retire early while maintaining part-time employment. When Social Security claims begin before full retirement age while work income continues, the Social Security Administration reduces monthly benefits accordingly. For 2024, here's how the regulation works. Those remaining under full retirement age throughout the entire year face an earnings cap of $22,320. Every $2 earned beyond this threshold results in $1 being withheld from benefits. During the year full retirement age is reached, the threshold increases to $59,520. Withholding becomes $1 for every $3 over this limit, applying only to months preceding full retirement age attainment. Let me illustrate with a concrete scenario. Suppose you're 64 and currently collecting Social Security payments. You accept part-time employment generating $30,000 annually. This creates an excess of $7,680 beyond the permitted limit. Social Security will withhold $3,140 from your annual benefit total. Understanding this distinction is absolutely critical. Only income from actual work triggers this provision. This includes employee wages and self-employment earnings exclusively. Pension distributions, retirement account withdrawals, investment returns, and rental property income are specifically excluded. Many retirees fail to recognize that their small consulting practice or freelance activities qualify as self-employment earnings. However, there's positive news to share. Upon reaching full retirement age, Social Security performs a benefit recalculation. You receive credit restoration for every month when benefits faced withholding. Your total lifetime benefit amount becomes whole again. Failing to report earnings with accuracy results in Social Security issuing overpayment notifications. Repayment will be demanded with deductions possible from all future monthly checks. Area number 4. Charitable giving from retirement accounts. For those interested in charitable giving, this regulation offers substantial tax savings potential. Proper execution is absolutely essential, however. The regulation works like this. Anyone age 70, 12, or beyond can arrange annual transfers up to $105,000 moving directly from IRAs to approved charitable organizations. The official designation is Qualified Charitable Distribution, abbreviated QCD. This transfer satisfies your required minimum distribution obligation while remaining excluded from taxable income calculations. The impact is tremendously beneficial. Your adjusted gross income remains lower than it would otherwise. You can avoid crossing Social Security taxation thresholds. You can prevent triggering RMDs surcharges. However, here's the critical mistake people make. Numerous retirees complete IRA withdrawals first, followed by charitable donations afterward. This approach completely fails to achieve the desired result. Withdrawals become immediately taxable once funds arrive in your personal bank account. The QCD tax exclusion benefit is permanently lost. Charitable deductions require itemization, while most retirees utilize standard deductions instead. Standard deduction amounts for seniors in 2024 reach $15,000 for single filers and $30,000 for married couples. Unless your total deductions surpass these amounts, charitable contributions produce zero tax advantages. The correct procedure works as follows. Contact your retirement account administrator requesting direct charitable transfer arrangements. Payment instruments must identify the charity as payee, never listing you personally. Receiving organizations must hold valid 501(c)(3) status with the IRS. Donor-advised funds and private foundations are specifically disqualified. Obtain written charitable acknowledgement documentation for your records. Your account administrator will generate Form 10999-R reporting the distribution. Form 1040 Line 4B requires notation as QCD to properly exclude it from income. Incorrect handling could prompt IRS examination and complete disallowance of tax benefits. Area number 5. Pension tax withholding and quarterly payments. This particular mistake generates the largest unexpected tax obligations. Pension and annuity distributions undergo automatic federal tax withholding unless you specifically instruct your pension administrator differently. Withholding control is exercised through Form W-4P submission. Without submitting Form W-4P, pension administrators withhold taxes assuming married joint filing status with 3 allowances claimed. This default withholding proves insufficient for many retirees. Let me explain the underlying reason. Retirement typically involves receiving income from multiple different sources simultaneously. Monthly pension checks arrive regularly. Social Security deposits continue monthly. Retirement account withdrawals occur periodically. Investment portfolios generate taxable returns. Rental properties may produce additional income. Each separate source withholds taxes independently without any coordination between them. When combined withholding fails to reach 90% of current year liability or 100% of previous year liability, underpayment penalties get assessed by the IRS. Quarterly estimated payments become necessary using Form 1040-ES. Submission deadlines occur on April 15th, June 15th, September 15th, and January 15th each year. Missing these quarterly payments triggers penalty calculations for each individual quarter. Penalty calculations utilize the federal short-term rate with an additional 3%. Compounding occurs daily. Large April tax bills that cannot be paid immediately result in mandatory IRS payment plan enrollment. These arrangements include both setup fees and ongoing interest charges. Protection is available through several mechanisms. Withholding adjustments can occur anytime through new Form W-4P submission to pension administrators. The safe harbor provision offers additional protection. When withholding plus estimated payments match 100% of the previous year's total tax, underpayment penalties cannot be assessed. For taxpayers whose prior year adjusted gross income exceeded $150,000, the safe harbor percentage becomes 110%. This protection continues functioning even when current year taxes ultimately prove higher. Now let me outline 3 immediate actions for protecting yourself from these IRS complications. Action number 1. Confirm your RMD obligation without delay. Anyone currently 73 or older should contact their retirement account administrator immediately. Request calculation of your specific required minimum distribution amount. Determine your exact deadline for completion. For those turning 73 during the current year, initial RMD deadlines fall on April 1st of the following year. Waiting until deadline day is strongly discouraged. Complete your RMD during December to prevent compressing 2 distributions into a single tax year. For anyone who has already missed an RMD deadline, immediately file IRS Form 5329 requesting penalty forgiveness. Demonstrating reasonable cause and proving active correction efforts becomes necessary. Action number 2. Determine your combined income and establish withholding procedures. Calculate the total from every income source you receive. Include pension distributions in this calculation. Include Social Security payments received. Include retirement account withdrawals taken. Include investment income generated. Apply the combined income formula for estimating Social Security taxation levels. Individuals with combined income exceeding $25,000 or couples exceeding $32,000 could face taxation on 85% of Social Security. Establish tax withholding from Social Security payments by submitting Form W-4V. Select a starting withholding rate of 10% or 12% minimally. Adjustments remain possible at any time. Additionally, complete Form W-4P submission to your pension administrator for pension withholding adjustments. Those receiving multiple income streams should utilize the IRS tax withholding estimator available at irs.gov. This tool determines whether quarterly estimated payments become necessary. Waiting until April to discover owing thousands in taxes is absolutely unacceptable. Action number 3, establish a comprehensive tax documentation system. Maintain copies of absolutely every tax-related document you receive. Store Form 1099-R received from retirement account administrators. Store Form SSA 1099 received from Social Security. Store Forms 1099 INT and 1099 DIV received from banks and investment firms. Store copies of Form W-4P and Form W-4V that you've submitted. Store receipts and acknowledgement correspondence from charities when making QCD transfers. Maintain these records for no less than 3 years minimum. During IRS audits, proving every deduction, every exclusion, and every withholding claim becomes mandatory. Without proper documentation available, the IRS disallows all claims and assesses back taxes, penalties, and accumulated interest. Maintaining a calendar tracking important deadline dates is equally important. Record RMD completion deadlines clearly. Record estimated tax submission deadlines. Record Medicare enrollment period dates. Use clear marking and establish automatic reminder notifications. Just one overlooked deadline can drain thousands from your retirement savings. Let me be completely transparent with you about something important. Relying on YouTube's notification system is fundamentally unreliable. Platform algorithms control exactly what appears in your feed and precisely when you see it. Should major regulation changes occur tomorrow, should Social Security modify payment schedules, should the IRS revise RMD penalty structures, my video might not reach you quickly enough. This situation becomes unacceptable when your financial security hangs in the balance. This is precisely why I've established the Global Senior Alerts official WhatsApp channel. This operates as a one-directional broadcast channel exclusively. Your personal phone number maintains complete privacy always. Instant notifications will arrive covering Social Security payment modifications, IRS tax regulation updates, Medicare premium changes, pension and banking regulation developments, and airport plus travel regulation updates affecting seniors. Upon joining, immediate access is provided to a complimentary downloadable resource called the Senior Benefits Protection Guide. Contents include a comprehensive RMD completion checklist, a combined income tax calculating tool, sample Form W-4V and Form W-4P with detailed instructions, a QCD step-by-step implementation process, and compiled official government contact numbers and website addresses. The joining link appears in the description section below. Access it immediately without delay. Join the WhatsApp notification channel. Download your complimentary guide right away. Postponing this action is not recommended. Leaving this to chance is unwise. Your retirement financial security carries too much importance. Before leaving, please watch the video currently displayed on your screen. That video thoroughly explains the Social Security overpayment situation currently affecting thousands of retirees nationwide. The SSA is actively demanding benefit repayments, while many seniors remain unaware that appeal rights exist. I provide detailed guidance through the exact forms and critical deadlines for self-protection. I appreciate your trust in sharing this information with me. Please distribute this video to anyone in your network who has retired or approaches retirement soon. This discussion extends beyond simple tax compliance. This concerns protecting the financial resources you spent your entire working life accumulating. My name is Edward, and I look forward to seeing you in the upcoming video. Remain well informed about these matters. Maintain your financial protections actively.